Okay, thank you. So I apologize, I'm on here a little late. Didn't get to do the first part of the show, but thanks for tuning in. We'll catch the second half, and we're ready to go. It's been a crazy week. I feel like I say that every week, though. But thanks for tuning in. Okay. Welcome back. This is Denise Nostrom, the Financial Chick. My company is in Medford, and you can reach me at 631-758-8691 or visit my website at financialchickshow.com. I'm here to help you on your financial journey. Over the years, things change, and I'm here to help you navigate all those changes. So yeah, it's been a little bit just this week. I don't know. I did notice that last night was a full moon. I don't know if any of you noticed that, but I definitely feel it. Like it's just been a little bit crazy the way everything is going on and everything's moving and shaking. And yes, a lunar eclipse. It was a lunar eclipse actually. So yeah, just insanity that's going on. So I forgot, I usually do a Facebook Live for the whole show. I didn't get to the first half, but at least you'll get to have this half. But anyway, so moving on. So we were talking about the market. And where I left off was that how the market can change in a heartbeat. So last year, at this time, in November of last year, the worst performing or the bottom three sectors were energy as the worst sector, financials, which was the second worst sector, and real estate as the third worst sector. Now, if we go into last Friday, we had just a total change where now energy is the best performing sector. So let me give you a number. It was down 50% at this time last year, which was a year to date. This year, it's up 58.1%. So when you think, and a lot of times clients will come to me and say, listen, you know, this fund's not performing well, should we sell it? Now, the answer sometimes may be a resounding yes, because maybe a manager left or, you know, the sector or the things that are involved in that particular fund or stock may not be very favorable. But a lot of times it's just, let's leave it and just wait, because you don't want to sell the losers all the time. Sometimes you do, but not all the time. Sometimes they're just waiting to do their thing. And that's exactly what happened here. To have a negative 50 to swing to a negative 58 within a 1 year, if you would have sold out at the bottom last year, you would have been sad, you know? So it's just, you have to kind of look at these things. And like I said, if you're not watching it, have somebody that is, like myself or a financial advisor. So one of the other things that we take a look at and that I've been explaining to people is, and I'm getting calls all the time. I just got one actually yesterday. Clients are saying, you know, or people are saying that they have money in their savings account. They have a lot of money in savings or in money markets or whatever the case may be. And what are they getting? Not a lot of rate of return. The Fed funds target rate is at a 0.25. And what that means is that's basically the baseline for what rates are for credit cards, for money markets, for savings accounts, et cetera, et cetera. So it's historic low rates, and people are looking to make more on their money. It's a really important thing. So, and the Fed funds target rate, pretty much when the pandemic happened, it's been at 0.25. We had some higher rates prior to that from 2015 to actually 2016. Right through the pandemic. But prior to that, we were at 0.25 also. So things change. And sometimes things circle around and come back again, which is also interesting. So one of the things that was also a very good case in point, last year at this time, inflation was running at 1.7%. So when I was doing financial analysis for people, and we were incorporating inflation and taxes into their situation, we were using around a 3%. So we were going a little high. Inflation this year, at the end of October, is running at 4.6%. So it more than doubled in just a year. Again, yet another thing that when we do planning or you're doing planning for yourself, you have to make sure that you're getting a good rate of return and we're beating inflation. It's great to say, you know, I'm afraid of the market. I don't understand. I'm just going to sit. I'm going to stay in like a fixed account, or I'm just going to stay in a money market because I feel comfortable and that feels safe and it feels secure. But that's a way to run out of money safely in retirement. And that's something that you don't want to do. So watching this key inflation or these key market indicators like inflation. Unemployment a year ago was at 7.9. So we've definitely had improvement there where we're down to 4.6. So that's a good thing. GDP was way out of whack last year. We were at a 33.1% because we were coming back from a point where everything was closed and things were starting to open up. So it really, really spiked. We're sitting at 2% right now. Again, the swings are nuts. This pandemic has made like just very interesting on a lot of ways. But you know, GDP at around 4% is kind of a good place. I know prior to, during the Barack Obama administration, they were indicating that we would never get back to 4%. And then when the Trump administration came in, we got to 4%. So that was right before the pandemic. So we were there, we bounced up and bounced down, but we're sitting around 2% right now. So I tell you these things because they kind of, you know, go into the planning that I do for my clients. We want to take into account all of these different things, because if inflation is high, obviously the money that you're coming in or the money that you're taking if you're in retirement, you may need more because you're not going to be able to cover your expenses. So everything matters, and this is stuff that you're not going to probably sit and watch and take care of or have the numbers in your head. This is something that comes into my office every single week. So we know we're on the pulse of the market and we know everything that's going on to help you. Again, it's not just about the investments. It's really about everything, the full-fledged planning. So in that vein, it's year end and there's planning, and I'd say most of my time right now is being spent on making sure that everybody has or will be taking the required minimum distribution. Required minimum distributions need to be out if you are over the age of, well, it was 70 and a half, but now it's 72 as of the Secure Act that changed last year. So I'm just going to say pretty much if within the past year you turned 72, you need to take it out. If you're over the age of 70 and a half and have been for a while or have been taking your RMDs, you need to do it. Last year there was a little bit of a hiccup because of the pandemic. People didn't have to take their RMDs, but it is back this year. So make sure, we only have a few more weeks left. If you have an IRA, or if you're not sure that if you need to take it out or how much you need to take out, you can definitely give our office a call and we can help you with that. But I'm sorry, it wasn't secured. The CARES Act. The CARES Act waived the minimum distribution last year, as I had mentioned, but they're back this year. And, you know, it is a complicated situation. So we even had like a little hiccup in the office because they're changing the RMD tables next year. They had indicated that they were going to change them this year for 2021, meaning that whatever you need to take, it's going to be a little bit less, the calculations. They're making a change. They haven't changed the required minimum distribution tables in quite some time. But the government couldn't get their act together. So we thought it was supposed to be this year, but it's actually going to be 2022. So you may want to start planning and making sure that whoever you're working with knows that they're changing, that the tables are changing next year. And really look at how that's going to change your financial planning, and if the RMD that is less may not be enough to accommodate for your expenses. So that's something that you want to do. And as far as RMDs, the other thing that the CARES Act changed was the beneficiary inherited IRAs. So if you had one for a while, that hasn't changed, but if you just inherited an IRA within the past 2 years, you need to take that money out within a 10-year period. Now, again, up to your situation, whether you take it all in 1 year, obviously that's going to be a big tax hit, or you take it over a couple of years. But I think the bottom line with any of this is make sure you have a plan of attack. With my clients, we have that plan of attack, whether they're using it to take it out to put into their Roth, or maybe they're taking it out, to purchase a home, a second home, a first home. So have a method to your madness. Don't do things willy-nilly. I mean, that's something that we help our clients do, is to identify their goals and then help them with the various products that they have to do the best that they can for their situation. So if in doubt, definitely give a call to the office. And I know I've said this numerous times on the program, but Roth IRAs. Take advantage of the conversion opportunities now. Tax rates are historically low, and many believe, as we all do, that rates have nowhere to go but up, possibly as early as next year. You know, the administration's meeting and they're looking at the bill, and, you know, it's passed one house, and, you know, there's a lot more to go. So we still don't have any definitive ideas of what's going to happen. But if we're betting people, we kind of know that there's probably a good chance that rates are going to go up. So do your Roth conversions. Again, call us if you need us, and we can help you through that. So we're heading to the end of the show. Thank you, Mike the engineer, for all your help. And I want to thank all of you for tuning in. But more importantly, I want to thank you, or wish you all, you and your families, a happy Thanksgiving, because next week, Thursday, is Thanksgiving. I can't even believe we're saying that. I don't know where the time has gone. But please enjoy. I'm thankful for all of you. I'm thankful for my family. I'm thankful for a lot of things. So it's time to really take a step back and really be thankful. We're pretty blessed in our life. So let's do that as a group. So thank you all for tuning in today, and I look forward to being with you again next Friday. All right. Yes, I apologize. We only had half a show today. I did not have the opportunity to get on quickly. But thanks for tuning in, and I'll see you soon.